Good morning, everyone. We are live. Welcome to the Genus monthly webinar, Investing in Turbulent Times. We will start in 1 minute. So if you need to get a coffee, tea, you have a minute, and then we will get started. Thanks for coming. Good morning, Fred. I can see that you've figured out the chat. Okay. Well, good morning, everyone. Thanks very much for taking time to be with us, and welcome to the Genus monthly webinar, Investing in Turbulent Times. My name is Ian Lusher. I am a partner and portfolio manager at Genus Capital Management, and I will be hosting today's session. I am with my good friend, Natasha Knox, financial planner from Alafia Financial Wellness. Natasha is the founder and principal advisor for Alafia Financial Wellness, a fee-for-service financial advisory. In addition to her many designations, she has a certificate in financial therapy from Kansas State University and serves as chair of business development on the board of the Financial Therapy Association. Her writing's been featured in the Globe and Mail, Money Sense, Forbes, and she's also been featured and quoted in publications such as Business Insider, Vox, The Financial Post, and more. She's also appeared on Global TV and CBC News Radio in Canada. So quite the resume for Natasha, and I've gotten to know her quite well because we're also both members of the Fraser Valley Estate Planning Council, and so I've known her for a few years. So not only is she, well qualified to do this talk, but she's just a really nice person. I know you'll enjoy what she's got to say today. So our topic today is investing in turbulent times. I think most people would classify today as a turbulent time. Liz Truss just resigned in perfect timing for this webinar. But I started thinking about this, and I was going to make a quip about how the last couple of years have been very turbulent. But the reality is turbulence happens all the time in our lives. Sometimes we don't know it. Sometimes we don't all have a big event that brings us together in turbulence. So this type of webinar and topic is actually useful pretty much at any time, anywhere, any place. We're going to have a lot of time at the end of the session for a good amount of questions. So please put your questions in the chat. It's also nice if you attach your name to those questions as well. We've added links to connect with both Natasha and myself in the chat on social media, and I'd encourage you to reach out to us if you wish after this. Before we start everything, I know that some of you, this isn't your first time using this webinar platform, but for the best viewing experience, the best thing to do is to maximize your screen. And as I mentioned, please type questions in the chat at any time. We'll spend a lot of time at the end trying to answer as many as possible. We'll also, if we don't have time to get to them all, we'll make sure to answer them afterwards, which is why it's important for you to include your name so we know who to send the answers to. If you're having technical trouble, you can let us know through the chat, and we'll have someone on hand to try and assist you. As usual, the classic best solution is to hop off and hop back on. It's like a reset. I'd like to start by extending my gratitude to the Indigenous peoples, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam, whose lands I'm honored to speak to you today. We do this to reaffirm our commitment and responsibility in improving relationships between nations and our own understanding of local Indigenous peoples and their cultures. Canada is home to the Indigenous people from across Turtle Island, and we're grateful to have the opportunity to meet and work on this territory. So without further ado, I pass it over to you, Natasha.
Hi, everyone. Ian, thanks for having me. I would like to just take a moment to let you know that I am coming to this webinar from the unceded ancestral territory of the Coquitlam, Kakite, Stalo, Musqueam, and Katsi First Nations. And I sit here in gratitude for their stewardship. They've been living sustainably on this land since before time immemorial. So without further ado, let me dive in. So I think generally speaking, when we're thinking about turbulent markets or markets in general, our emotions can sort of be classified into two broad groups, one being enthusiasm and one being fear. And each of these sort of general categories, it's an oversimplification, can have sort of a spectrum of emotions. So a low intensity, enthusiastic emotion might be some sort of curiosity, moving up hopefulness. In the high intensity emotion, you might be feeling elated or exuberant. And similarly with fear, it could be something as low intensity as unsettled, moving up to nervous, maybe anxious, uncertain. And then on the high intensity, it might be frantic or panicked. That would be an example of a high intensity emotion. And, we're all experiencing the same markets, but our experience of it is going to be very different depending on where we are in our life and some combination of our needs, our personalities, and our lived experience up to this point is going to inform how each person is particularly experiencing the world events today. So I thought that to start, we would see if we can name some of the emotions that everyone on this call is currently feeling about the markets. So I believe that there's a poll. So there it is. So if you could just take a moment to let us know if you're feeling a low intensity version of enthusiasm, maybe a high intensity, low intensity fear, high intensity fear. Okay, the answers are coming in. Okay.
Oh, these people are quick.
They are.
We have
Okay.
a trend here, I think.
There is a trend in that people, I've seen that for the most part, it's low intensity is dominating. Low intensity fear is dominating. There's probably some uncertainty, unsettlement. Um, feel free to pop if these words aren't really hitting the mark for you and you're feeling something different, maybe feel free to pop it in the chat.
Yeah, it's interesting that the low intensity fear and low intensity enthusiasm are the top two. So with
Yeah.
obviously some high intensity fear mixed in. Not a lot of high intensity enthusiasm though. So
Yeah.
there you go. And I think
Yeah.
a couple people have mentioned in the chat, kind of expanding a little bit, kind of fear mixed with opportunity, um,
Okay.
anxiety, more anxiety than fear, these types of things.
Okay. Wonderful. So I would just invite everyone on this call to just take a moment and jot down the emotion that you're feeling and possibly where you feel it. If you're having a sensation in your body somewhere, um, maybe where you feel it, and if you're able to describe it. Um, sometimes people have sensations in their shoulders, maybe in your chest, maybe in your stomach. Those are common places that people might feel it. Maybe in your jaw. That's another common place where these sort of fearful types of things might reside. Enthusiasm sort of lives often in the chest. It might feel like fluttering, excitement, anticipation. I would invite you to just take a note of where these emotions sort of reside. And then I guess the other thing I wanted to touch on is if you're able to perhaps connect it to a need of yours. Usually, um, these emotions arise in response to a need. So, for instance, the emotion of fear might arise in response to a need that's not being met, such as a need for certainty, which would be connected to a need for security. Um, that would be a common one. It could be a lot of other things. Um, the enthusiasm might be in response to a need for financial well-being that is currently being met. Um, so those would be some examples. Okay. So for the most part, our thoughts tend to reside in the past or in the future. A lot of times our thoughts aren't completely centered in the present. So thoughts that are residing in the past might be ruminating on past decisions or past events. So this is your lived experience. And sometimes people have a tendency to sort of go back, especially in response to market turbulence or turbulence in life. It can cause us to reflect on our lived experiences. So consider for a moment, what some of the thoughts are that are running through your head. Um, you know, Thoughts that live in the past might be something like, if only I hadn't, or if only I had, or I miss these days when, or the last time um, XYZ happened, or I should have, they should have, we should have, or shouldn't have, or it might be, I wish I hadn't, or I wish I had. Um, those would be characteristics of thoughts that tend to be in the past. There might be emotions that come up in response to thoughts in the past when we think about it. So nostalgia, that is an emotion that sort of comes up in response to I miss this or I miss that. It's a fond memory. Anger, guilt, regret, those might come up in response to um, I wish I had, or they shouldn't have, or I should have. Shame would be a similar situation. Joy and pride can also come up in response to I miss or I remember when. Um, so try and see if you can think about when you're thinking about thoughts in the past, what are some of those emotions that are coming up for you? Sometimes your thoughts are residing in the future. Not everyone is thinking about the past. So a lot of times in response to market turbulence, we're seeing questions such as, what if this happens? What if that happens? How will I do this? How will this happen? How will this come together? Or another common one is, if this happens, then that will happen. Or if this continues, then this will happen. Or this, I fear this may happen. So that's another common sort of train of thought and thoughts that belong in the future, or if your thoughts are in the future, they might sound something like that. So when you're thinking and you're living in the future and your thoughts are somewhere in the future, it could be hope, it could be optimism, it could be confidence. That would be going back to our initial slide on the enthusiasm end of the spectrum. But it could also be fear, it could be uncertainty, it could be dread, depending on what those future thoughts are. So we have another poll coming up. Can we take a look and see um, where are your thoughts? Future, future, past, mix of both. Mhm.
Not too surprising. Lots of future.
Lots of future. Yeah. And yeah, a mix of both. So that's interesting. So sometimes our lived experience gets pulled in because our lived experience informs how we think the world and the markets work, which is completely understandable and completely natural. It's not the way it actually works, but it can seem that way, and often does seem that way. And so then we extrapolate that into the future. So that makes a lot of sense. Great. This is fabulous. Hey, thank you, everyone. Okay, so now we're going to try and tie this all together to sort of see if you can understand your story. So I invite you all to sort of take a moment and just try to pull together what we've been talking about. And this statement sort of assumed that many people on the call would have thoughts residing in the future, which is, as it turns out, the case. So if you can have that, I'm feeling the emotion that you identified earlier, because I think, and this is just for your own use. So it doesn't even matter if it is rational, it doesn't matter if it's reasonable, no one else is going to see it. Just write down, what is the thought that you are thinking might happen, that future thought. So I'm just going to give you a couple seconds to just jot that down. Okay, I hope everyone has had an opportunity to jot down their response to this statement. So in order to make this statement that you have written down true, what is the belief about money or the markets that is underlying the belief or thought that you just wrote down? And then the final slide is, I'm going to invite everyone on the call to reflect on how this belief shows up in your life. How does it show up? Are there other ways that it shows up? Does it show up in your behavior or your actions or your impulses? And what might have been some of the consequences of those behaviors? Okay, so really the purpose of this exercise that we have just explored is to sort of surface some of the underlying beliefs, some of the underlying emotions, so that you can better understand them, so that they are not sort of taking up real estate in your mind without your awareness of them. Because very often our behaviors are being driven by our feelings and our lived experiences. And this may cause us to behave in ways that are not associated with great investor outcomes. So it's really, really important for us to understand where all of this is coming from, because in order to adhere to proper investing behaviors, we need to accept that our feelings are real, right? We're not trying to suppress how we're feeling because feelings just are. So we acknowledge our feelings, but then reflect on how our perception of our lived experiences is now impacting our ability to adhere to what we know based on evidence is investor behavior that is going to set us up for long-term success. Now, now that we've completed this reflection exercise, I'd like to turn it over to Ian to discuss what exactly that might be.
Thanks, Natasha. I was actually listening to what you were saying, and I I was in Key West in August, and I met a gentleman, 75-year-old New Yorker, and we were obviously in the same place, so I ran into him quite frequently and probably spoke with him for about 10 hours. And he was talking to me about the markets, all sorts of things, and he had like a really good outlook on things. He just said to me, this is probably my last cycle. I'm not too worried about it. It might take a year and a half, but I'll be fine. It's all these cycles, they go down a little bit and then it comes back up. I've delegated everything. And I was like, wow, this gentleman has like a really good outlook on the market. Doesn't seem too stressed at all. But then the next probably 3-4 days, I got to know his story. And I found out that he was a Vietnam vet who had suffered a lot of PTSD. He got through that. He, had to go through a divorce because of PTSD. All these different things happened to him. He more recently had a heart attack, and so he had to stop running. He was running marathons. Very in shape guy, 75-year-old. And I was like, okay, this all makes sense, because to him, what was going on with his portfolio was so minor compared to his past experiences. So it just shows you everybody has different ways of looking at things. And so, our jobs are to try to figure it out with each client, what their emotions are. Sometimes they don't tell us. So the first thing that we have on my end, and first thing you can do is talk to your PM. So talk to your portfolio manager, or, there's people here that are on this webinar that may not be Genus clients. I know that. Talk to whomever you deal with, and we can try to work through some of the issues. Because the reality is we actually don't always know what you're thinking or what you're feeling. And I'm going to go back to good old March of 2020, when we had a big market decline over a really short period, maybe 2.5 weeks. A lot of turmoil going on, a lot of turbulence. And some of the people that I thought that I was really worried about how they were going to react to the situation, nothing. They weren't worried whatsoever. And it took me a while to figure this out later on. But the reason for that was they were actually more worried about everything else. They were worried about COVID. They were worried about losing their job. There were so many things going on that they were more worried about, that this became secondary. And at the same time, actually, some people that I just assumed, fairly savvy, people that have been through multiple cycles, I assumed they would be completely fine with what's going on, or not fine, but dealing with it well. Very concerned. So the point is you should talk to your PM, talk to your portfolio manager, because we can't read your mind. We can't read your emotions. We don't know exactly how you're feeling. We have ideas in our head of where certain clients would be right now feeling, and where other clients would not be, but they may be completely incorrect. So the best thing to do is just reach out, particularly if you're in the fear category. I would say anywhere from low intensity to high intensity, but really if you're high intensity fear, reach out to your portfolio manager, because we will tell you a few things that I've run into in the last several weeks with clients that you may not have thought of. So one is, your portfolio is different than the market, right? You have a portfolio. Our job is not to go to cash and get lucky and avoid complete losses. That's pretty much impossible to do. There's been studies after studies after studies. It's not realistic that any portfolio manager or any investment firm is going to put you on the sidelines just before, right at the peak, and then things are going to go down and then they're going to put you in right at the bottom. That's not really realistic, but what we do in your portfolio is we're trying to tweak things. We're trying to take things out of higher risk areas. Maybe the technology sector, you'll probably notice in your portfolio, we have very little of that these days compared to 2020 when we rotated coming out of that big bottom in 2020. We bought a lot of technology back then. So we do the best we can with the tools we have to try to use a portfolio approach to, in this particular situation, try to lose as little as possible versus a market, both bond and equity, that are really struggling right now. The other thing is that comes up quite often, and the only reason I'm bringing this up is because there might be people in the webinar that have been worried about this. So I thought I'd bring it up in the Talk to Your PM section, is people get really worried about cash flows. And again, it comes back to the portfolio manager approach, the portfolio approach, the way we look at things. When we design a portfolio, if a client has cash flows from the portfolio, meaning we're paying you monthly, quarterly, you have, we pay income on some sort of scheduled basis, we will have in those accounts more cash, less risk. In your TFSAs or things like that are more long-term, that we know that we're not going to take money out of, those will probably be higher equity weighted. Everybody's different, but in general, if there's cash flows, we've already got a lot of them secured for several months. So the market fluctuations don't affect those as much as the other accounts that are deemed more long-term. So it's a portfolio approach, and people don't actually realize that we're doing that sometimes. So talk to your PM and you'll find out what we're doing, what we think's going on, and we'll be candid about what's going on currently and what we're trying to do. And you'll feel better. Knowledge is always better. Whenever you talk to somebody who's handling your investments or you're worried about something, the more knowledge you get, the more comfortable you feel with what's going on. Now, delegate. So, Genus Capital Management is a firm where we do portfolios for clients. You're delegating us the investment authority over your accounts. And so we're doing everything we can to obviously try to lose as little as possible in these types of markets. But you have to remember, you are delegating that responsibility. So you are, at the same time, you're actually delegating some of that worry, some of those emotions, because that's our job, is to worry for you in some cases, where we're doing a lot of work on risk management to try to make the portfolios better. We talk every day. We have a lot of metrics that we use, which will go into the next section. But the main point is when you delegate that investment risk, you are in a sense delegating a little bit of that worry that you're feeling right now onto us. This is our job, and we take it very seriously. For those of you who haven't delegated responsibility, you might feel completely different right now. So there's people who are running their own portfolio. Obviously not Genus clients, but there's a lot of do-it-yourself investors out there right now. And we know that a lot of these types of investors don't worry about risk so much, particularly when things are going really well. So they have a whole range of emotions right now. It's their own money. They're seeing what's going on in the world and in the markets. And this is where some of these things that Natasha was talking about really start to pop up, because the fear just really kicks in, and it might make them do something that really could hurt themselves long term. It might feel good for about 2 seconds, and then long term it's one of those, I wish I didn't do that back in the day, is what ends up happening. So if you're one of those types of people, who do your own portfolio, or perhaps you are in a portfolio right now that's not discretionary, where there's not somebody managing it. Either go talk to that person or talk to us, and we will try to give you the best advice possible. In times like this, and this is from a portfolio manager's view, we're humans too. So we feel a lot of emotions just like you do. You know, one thing is we have some separation because we're investing money. We obviously have our own money that's invested, quite often very similar to yourself. But we're a little bit removed in that when we're making decisions on your account, we don't have that tie of it's my money, right? We have a little bit of a bridge of emotion that often makes people make mistakes, their own money, right? It just heightens their emotions. So that being said, we still have emotions. We are humans. And what we do at Genus is we use a lot of quantitative metrics. We leverage quantitative metrics to try to get out as much of the emotion as possible. Some of the portfolio managers here, I would say most of them, we're kind of naturally, we have like a natural disposition to not get that riled up. I have a low heart rate. So it takes a lot for me to get really rattled. But that being said, when you're using a lot of data and you're using a lot of metrics and you're using a lot of modeling, it makes you, those emotions kind of subside. So that's what we do at Genus. It helps us guide us through tough times. This happened back again. I'm just going to go back to 2020. There was a lot of things going on. I was personally feeling social emotions, right? The portfolio, I was spending long hours overnight, doing a lot of reading, trying to do everything I could to try to figure out what was going on. But what got us out of that and what made us realize that this actually is going to get better quicker, now I'm talking about 2020, is we used a lot of quantitative metrics, and we realized pretty quickly that even though that the decline was quick, the recovery will probably be not quite as quick, but the recovery is going to be a lot quicker than people think. And so we went from worrying about what's happening today to looking to how we're going to position things for tomorrow pretty quickly. We use a set of models we call dynamics. For those of you who aren't Genus clients, we use our own proprietary models, and then we also use a lot of data from other firms like Piper Sandler, Renmac. So basically, we have our own models that we use to try to remove some emotions in the market to help us and guide us on how to position portfolios. And we have to lean on them in times like this because that's what gets us out, and it's worked for many, many years for Genus. And I'm quite sure it will continue to. Now, this is a really good one. This one's my favorite one. That's why we kept it for last. For those of you who may not know, I actually used to write for Daily Hive back in the day, not on financial matters, but on the Vancouver Canucks. And one thing I realized pretty quickly is when I put an article in to the editor, not only did my title look completely different than what I actually wrote, but half of the words inside of my article were completely changed and cut out. And sometimes the articles look nothing like I actually proposed them, which took me a long time to get over. But so I would just exercise caution with media. And I'm not saying that to say don't look at media sources. Of course you should. But one thing I would say, there's been a lot of studies, particularly in the social media era, that a lot of people read headlines and then they don't actually read the article. So one thing that I would say is read the article and see what the content is, because quite often the the title, the headline, doesn't really match the content. So that the headline is there to get you to click. That's the way media works these days. It works on clicks, views, these types of things. So they have to have something fairly drastic. Basically, the more drastic the headline, the more likely you are to click. And it's just the truth that negative attracts much more attention than positive. So in times like this, it would be very easy for any of you to find extremely negative articles. It'll be very easy for you to find extremely negative headlines. But often when you click on those negative headlines and you actually read the content, it's not quite as drastic as the headline is. The other thing that is interesting in today's world with the media is, particularly on social media, but even on Google, when you click, and same with YouTube, when you click on things, what these algorithms will do is keep sending you things that you've already clicked on. So it'll send you, say if you are looking at market crash or market uptick coming, you'll keep getting a lot of articles that come up quickly that are very similar to what you've already clicked on. And basically what they do is they give you it's kind of a confirmation bias. So if you have something in your head that you're worried about and you're seeking it out and trying to get information if what you're thinking is true, you for sure will find it, because you can find anything that you want. Anything that you believe right now, you will be able to search it out and find it aplenty. So what I would say is just to exercise some caution that this is how the media works these days, for better or for worse. This is how things work. So, you know, the gist of this is just pick your sources. They can be completely whatever you want. Just make sure that you read full articles and try multiple sources as well. And that all reverts back to the first part. If you're reading a lot of things and it's making you feel more uneasy, talk to your portfolio manager, because sometimes these articles aren't totally true, or, you know, sometimes they're talking about clicks. Sometimes it's totally unrelated to your portfolio, which is what happens quite frequently. There's a lot of things about the market, and what you need to realize, and you know, portfolio managers need to do a good job with their clients, is that the market isn't necessarily the portfolio. A lot of Genus clients have done, you know, a lot better than the markets right now. Everybody's going through the same thing, of course. Multiple asset classes have not done well this year, but it doesn't mean that you own all of them in perpetuity and in exactly the form that they are that you see in the headlines. So your portfolio is different than what you're reading. And just talk to your portfolio manager and you'll feel more informed, and you'll often feel much better. Okay, I've probably spoken enough, I would say. So this is the time for a question and answer period. You know, we have Natasha here. So if you have any questions to Natasha or myself, we can put them in the chat and I will try to curate them a little bit. I'm just waiting for, there was a couple questions early, so I'll bring some. I will answer one here because one is to me. Okay, I'm going to answer one here. And it was a question from Randall. And I will send you some questions here once I get some, Natasha. It's just this one's one I'll probably answer. Given market ups and downs, can you possibly touch on timing when withdrawing from funds from accounts and replenishing them? Excellent question. So I kind of spoke a little bit about this earlier. With clients that we know are doing withdrawals, we look at what the signals are ahead of time. And in those accounts that are actually providing the income, we've already set aside some lower risk assets, some cash, these types of things to fund the withdrawals. And then obviously with replenishing, in these type of markets, if you're replenishing funds, if you're somebody who is adding to a portfolio, it's always good to do kind of piecemeal deposits, so monthly deposits, those types of things. Usually really can do well taking advantage of turbulent markets like we're having right now. Okay, not a lot of questions. Let me see here. Okay, this one's another one here. And you can chime in, Natasha, if you think that this is coming from somewhere else. Because Natasha's portion is more about, where these fears or where these questions actually come from. I don't want to just answer them because people are obviously interested in investment questions. But this question was, what might older investors want to do as a defense against future market losses, given that a recession is predicted? So that question, obviously I can answer it from a investment point of view, but I noticed there's a couple things there against future market losses. And it looks like there's this feeling, as an older investor, it's this fear that I don't have enough time. Can you speak a little bit about that, Natasha?
Well, I can try. So that question, it's actually a very interesting question because I think it's part an emotional question, but it's actually part a planning question in the sense that I'm curious, and to the person who asked it, you don't have to respond here, but have you had a thorough plan created for you? Because typically when a planner is creating a plan, they'll do something called like a Monte Carlo analysis on it, which it's not a best or worst case scenario, but it will sort of show you a range of probabilities of your plan succeeding based on based on your portfolio and the characteristics of the assets therein. So that's actually your starting point, is actually understanding, because my guess is that underneath that question is the question or the fear, am I going to run out of money? Like that's would be my guess as to what is going on underneath that. So we actually need a combination. We actually need a rational answer to that. Like, do you have enough? I don't know. That would be step one, is to sort of figure out without trying to predict. So whether a recession is happening or whether it's not, or how fast inflation is going to come down, is you actually need to do a little bit of financial modeling first to understand your
position. So Natasha, she actually said that yes, she does have a financial plan, and I think her this is actually a pretty common worry is, and I think this is because in this particular cycle, for most of the year, the bond market, which is traditionally seen as safe, has not done well with yields going up. And so she's saying, she feels like there's less conservative choices available, which is actually like a not incorrect at this exact moment, but that doesn't mean that will go in perpetuity, right? Very interesting. I have a question for you, because I'm just kind of dovetailing off of this, is we have a lot of older clients or clients that are retired and they haven't seen lower risk assets like bonds go down in a smaller period of time like this since the 1980s. And how do we, I think in logically, it makes sense that this is not going to continue forever, right? But that doesn't change the emotion today that I don't really have any choices, and even the bonds are going down. So can you address that a little bit? Is it just like a fixation on what's happening today or on the bottom line of your portfolio that's kind of affecting your logic?
Well, sure, because I think that the extension of that question is, what does this mean for me? Right? So there aren't those same attractive, more conservative choices. And then the unspoken part of that question is, well, what does this mean for me, for my future? And so that's the piece that actually requires um, some analysis to figure out, and also some, figuring out which elements are within a person's control and which are not
Right.
within their control. So there are a few things that are within people's control and a few things that are out. It's hard for me to
Yeah.
answer that without knowing the specific
Yeah.
situation. Um, and then depending on what the needs are and the specific financial situation, that's when you can start to explore certain
Right.
options to see what is suitable. But I think, yeah, I think that the missing piece of that question is, what does that mean
Right.
for me?
Yeah. And she asked another question about rebalancing. And so the flip side of this is bond yields have gone up quite a bit. So the portfolio manager in me looks at it completely different. Obviously, we've gone through what we've gone through, which isn't fun. And it happened really quickly too. But going forward, we haven't really had good yields in bonds for quite a while. So that bond part of the portfolio or your lower risk part of the portfolio has been there, but only as a safety valve. It's not really yielding anything. It hasn't contributed to return, which isn't really healthy. And so going forward, a lot of these assets are now have higher yields on the bond side. So as a portfolio manager, it's actually going forward, not looking behind, but looking forward. It's like this will actually help going forward. It might not help starting tomorrow, but it's going to help long term because we're going to get a lot better returns from our lower risk assets going forward because the yields are higher. And that's been one of the tricks of in the last several years is that we've been getting almost nothing on the low risk side. So we almost had to go through this to actually get better returns from that area going forward. So, and yes, we do rebalance. So like right now at Genus, we've been raising cash for quite a while. We've been reducing equity exposure, and then we have started dipping our toes and buying some of those again. So that's what a portfolio manager will do is this is what we're in now. We'll get through this cycle, but coming out of this cycle, much like we did in 2020, where's the best place to position us for the next cycle? Oh, Danny's asking about recession. Well, so Danny's asking about recession from no to maybe to yes. I would say it's. I think in the U.S. the Bloomberg came out and said there was 100% chance of recession, but another thing that clients should realize when they ask these questions about what is going to happen, a lot of these things have already been forecasted by the market. So what we're thinking about today is there going to be a recession, which is obviously, worry and fear and anxiety, is the market's already discounted for that in quite a few respects. So the market and portfolio managers are actually starting to look of like, when are we going to get out of the recession, or how long is the recession, not if we're going to have one, right? So that's why it's good to talk to your portfolio manager, because we might not be thinking as immediate as today as you may think. We're actually working on today and tomorrow in kind of conjunction with your plan, with your cash flows, with your own risk tolerances, with your own needs, all these types of things. So there is a good question here that I skipped over and I need to get to it. Okay, Natasha, how do we remind ourselves of the I am feeling exercise you took us through in the moment when we're getting fearful or overloaded emotionally?
That's a good question. How do you remind yourself? Well, I think it starts as a practice. So what I mean by that is you can start practicing taking note of your emotions. That is why I actually suggested that you take note of the physical, because sort of a way of remembering is that feelings are felt. So what that means is that when you're feeling a feeling, you usually feel it somewhere in your body as well. And so um, if you start making a habit of noticing your physical sensations, you strengthen your mind-body connection, and you start to become aware of um, of your feelings, because very many times we go through the day and we're feeling stuff, we don't necessarily articulate it, we don't necessarily even realize that we're feeling it. We may actually sometimes start to feel like a little twinge or a little flutter or a little knot, and then we just instinctively react to make it go away because we know that that feeling is maybe associated with something not so nice. So we're trying to avoid that feeling. So um, make a practice of noticing what you're feeling, naming it, accepting that that is in this moment what's going on for you, and making a note of where you feel it in your body. And you'll just get better at it over time.
Thanks. We have time for one last question. This actually comes from me, just because I talk to a lot of clients. And what I'm noticing is bottom line trumps everything else. So even though a lot of clients have different circumstances, they may not need the money anytime soon. They may be doing cash flows and have, even though we may have, even though we have things already earmarked to pay out those cash flows, and we've done a cash flow analysis that says that they don't, they're not spending all the money tomorrow. This is actually very long term. Clients are still getting stuck in my bottom line number is this, and I'm worried. Is there anything that they can do other than, talk to their portfolio manager? But a lot of that, again, comes from fear, thinking they're going to run out of money, or maybe even thinking that, their portfolio manager was going to be some sort of magician and somehow make 10% when the market's losing whatever, right? So what do you say to those type of people that it's really an emotion, am I correct? That it's making them focus on one thing and everything else?
Well, it's almost I would say it's more of a belief, right? So there is some underlying belief there, and maybe the belief is just all that matters is my bottom line today, or I don't even think that's the belief. There's some other belief underneath it that results in that sort of conclusion.
Right.
So it can be a little hard to try to get to what the root of the actual underlying belief is about that. But there is some perspective there on that's rooted in an expectation, perhaps, that the bottom line is going to increase year over year steadily, no matter what, maybe. Um, and there might be also some, it could be a cluster of different beliefs around money, possibly feeling that there is never really
Right.
enough. I'm not sure. Like it's going to vary from person to person. So the statement might be the same, but the actual underlying belief that is driving that conclusion could be different, and it has its origins in that person's lived experience.
Right.
So until you can get to that, until you can get to what that lived experience is that makes this true for them, it's going to be hard to sort of move forward. So actually what you're trying to do is dig deeper, find out what the lived experience is that sort of was the original catalyst for this belief. And there may have been other lived experiences that sort of caused this belief to become re-entrenched, but then leads to this conclusion that all that matters is my bottom line today. Versus how a portfolio manager or a planner might look at it is, we're looking at the bottom line over time, over a long period of time. And that's, associated with better outcomes versus looking at it at a fixed point in time and making a decision on that one fixed point.
Yeah, that helps. Unfortunately, that's all we have time for questions. Interesting point on that last one is it seems that those types of thoughts don't seem to relate to the amount of money that people have. So one other person may say this person has way more money than they'll ever need in their lifetime, or maybe 2 lifetimes, but they'll still have the same feeling. It's interesting that, and that's why I wanted to bring that up. So that's all the time we have today. If there's any questions that were not answered, we'll make sure to answer them. I think we got to them all, but we will answer any ones that were unanswered. Please stick around for a few more seconds as we have a survey that will be redirected to you to get your thoughts and feedback on the webinar. I want to thank all of you for taking the time to attend this webinar, all our valued clients that are here, all those who are maybe new to Genus as well. A huge thanks to our speaker, Natasha, for taking time out of your schedule to be with us today. Genus has made a donation to the charity of Natasha's choice, which is Cool Earth, as a thank you to Natasha for her lovely appearance today. Great work, actually. It's a really good topic and different, which is good. I'd also like to thank all the people behind the scenes at Genus that put this together. It isn't actually that easy to get this to all run smoothly. So thank you very much. I'd like to ask you to join us to our next month's webinar hosted by Stephanie, a Sustainable Investing Spotlight, where we'll take a deep dive into some of the sustainable investments we hold in our funds through our Impact Investment Council. We'll explore what impacts your investments in sustainable companies have on these companies' success, their customers, communities, and other stakeholders. You can sign up for that webinar using the link in the chat. Don't forget that there will be a recording of today's webinar that we'll provide to you via email, and it will also appear on our website in the next few days if you'd like to revisit it or share it with your friends and family. So once again, thank you very much for attending. Much appreciated, and enjoy the rest of your day.